Let me just say something about how we see life at the moment, and the answer is tough. We see no green shoots, no yellow shoots. I was at the Sun Valley Media Conference last week, and Wilbur Ross referred to moss. We don't even see moss. It's very barren. And we don't see any improvement in April or May. I haven't seen the final numbers for June. We're in a close period, so I do risk being taken to jail if I say too much. Close period for our half-year results, which come out at the end of August. But I haven't seen the final figures for June, but it's pretty much directionally where we were going in April and May. So we don't see any of those green shoots or recovery. And it could be that we lag. I think we lead the downturn. So if clients get worried about how business is going, they cut. We think unwisely, but they cut, and cut discretionary spending. And similarly, or not similarly, but on the other hand, as things improve, we lag. So clients don't invest more until they're sure there'll be a recovery. And I think that's generally the position. I'd have to say that psychologically, I think CEOs and CMOs feel better. So they feel better than they did 3 months ago. But the head and the heart might be better, but it hasn't sort of gone down to the hand which writes checks yet. I think we feel pretty gloomy about what's going on at the moment. Now, having said that, second half of the year will look better than the first half. And the reason it will look better is the comparatives get easier. Last year, our like-for-like revenues were up by 3%, 2.7 to be precise. And in the quarters, they went 4, 3, 2, 0 from first quarter to fourth quarter. So it's much easier to lap 2 and 0 than it is 4 and 3. And I think that's what happens in the second half of the year. And similarly for 2010, and I've described 2009 as being a write-off, and I'll stick with that. 2010 must be easier because you're lapping a very tough 2009. 2010 has some things going on, by the way, which are sort of positive. 2009 was always going to be a tough year because there were no events. There wasn't a Beijing Olympics, for example. There wasn't a European Cup, football cup. Next year we've got the Vancouver Olympics, we've got the Shanghai Expo, we've got the World Cup in South Africa, and the fourth event, which is probably the most significant, is President Obama has to go to the electorate again, effectively. And by November 2010, the recession will be President Obama's recession, not President Bush's recession. And that, because if things haven't changed, he will be blamed rather than the previous president. So that election has an important bearing on, I think, what's going to happen and what's happening in terms of fiscal and monetary stimulus. We think there will be a recovery of sorts. It will be anemic in 2010. Nouriel Roubini, the Dr. Death or Dr. Doom, I think he's called, actually, before the market closed in the US last night, it was indicating that he thought there was going to be a recovery in 2010. After the market closed, he issued a press release saying he didn't really say that, and it was no different to his doom saying of previous months. But I think, by and large, it seems to me that it's L-shaped if you're looking for a shape. Maybe an italic L, one of those L's that flips up a bit, but it's going to be pretty anemic, I think, into 2010. And it's going to look as though it's better, but not really be tremendously better, and it'll look better because of the comparatives. I think the real problem is not 2009, 2010, but what happens in a little bit longer, because the fiscal stimulus, which is massive, we gave up calculating what the fiscal stimulus was at WPP at around $12 trillion. So the world's economy is about 64 trillion. The US is about 14, GMP is about 64, US is about 14, is about 25%. The fiscal stimulus, if you added it all together, up till a few months ago, was about 12 trillion. So almost 20% stimulus in terms of GMP. These are very big and unprecedented numbers, and unprecedented Keynesian stimulus, fiscal stimulus, and we've had money stimulus as well. We know we have quantitative easing, which is a posh phrase for printing money. I mean, I never thought I'd hear the governor of the Bank of England. I woke up one morning and there on CNBC was Mervyn King saying, you know, if we don't do enough, we'll do more. And so I don't think it's a worry about whether we'll get out of this. We will get out of it in the short term. I think the worry is the longer term. And will governments have the courage to cut government spending, to reduce deficits, increase taxes, risk putting up unemployment still further, and the political consequences of doing that? And I don't think they will. And simply put, I think we'll inflate our way out of it, like we did in the 70s. And that means higher rates of inflation, which for us actually is not bad. For our clients is not bad because they have more pricing power. But if it gets out of control, the problems of longer term interest rates rising and inflation are quite severe. So I think, you know, I'm not saying there'll be a double whammy or a W if you're looking for shapes, but I do think that that issue is one that we tend to lose sight of.